Welcome to Unit 4 of the CRCR Coaching Course for Post-Service Financial Care. In this section, we will walk through the full sequence of financial care activities that occur after services have been delivered. This includes cash posting, credit balance management, exception-based processing, self-pay follow-up, 501R requirements, patient debt regulations, medical account resolution, and outsourcing. In this section, we will discuss the internal controls for cash posting, the difference between Jennifer Ledger and AR Cash, EFT, ERA posting, and the 4 levels of automation of our remittance postings. Cash handling requires segregation of duties, internal and external audits, reconciliation, and multi-level authorization to ensure financial integrity. The daily reconciliation workflow includes totaling payments, batching, endorsing checks, preparing deposits, posting cash and adjustments, handling unidentified payments, and balancing the GL. Processing general ledger cash payments for miscellaneous purchases requires the same separation of duties when processing patient payments. Examples of additional miscellaneous payments can include cafeteria receipts, gift shop receipts, and parking receipts. Each payment should be logged within your department. Payments should be secured and receipts should be issued. Receipts should be grouped or batched by payment type and totals and balanced to the receipt log. Payments should be totaled and documented by the business office cashier, and payments are delivered to the cashier, who then retotals the payments and validates that the totals agree. The cashier then completes the bank deposit slip. So high level, general ledger receipts refer to non-AR cash that needs to be logged, secured, batched, totaled, rechecked by cashier staff, and deposited appropriately. When we talk about electronic funds transfers, or EFTs, the EFTs move funds quickly and reduce manual work. ERAs in the 835 format provide payment detail. Automation levels range from basic data receipt to full auto posting. So EFTs, they transfer funds from the payer to the payee through the banking system. It's the fastest way to move money because it's possible to transfer funds between the banks on the same day. And this is a network of money movement that's available to banks through the Federal Reserve System. So EFT balancing and controls, the use of EFT simplifies cash balancing and control requirements since the cash is deposited directly into the provider's bank account. The bank informs the provider of the amount received and issues a deposit. The provider balances this to the electronic remittance advice, or ERA, received. The actual posting of the EFT dollars to the account receivable may be accomplished in many different ways. Typically, predicted on the receipt, either a paper remittance advice or an electronic remittance advice, and then control logs must be maintained to ensure that all EFT deposits are posted to the patient accounting system in a timely manner, which is typically daily. Level 4 is our total automation of receipt, data entry, payment posting, and adjustment processing. In addition to everything that was included in Level 3, this level links with banking information to allow reconciliation of payments received electronically through a non-bank network with funds received electronically. Medicare logs and the secondary billing process are automated using ERAs. An electronic explanation of benefits received from the primary payer is transmitted electronically with the secondary claim. Manual intervention is only required to handle disagreements or where your automation fails. Moving on to balancing and control steps. There are many components to each payer's remittance. They include the payment amount, information on zero payments, partial payments, contractual allowances, and patient deductibles and copay responsibilities. Each transaction type must be balanced and controlled to ensure that incorrect payments, incorrect contractual adjustments, and denials are identified, and the patient's account reflects the correct balance. The following steps will ensure proper balancing and control of the ERA postings. You need to download the ERA electronic files and review the payment amount with the EFT payment amount. Process against system filters to identify items that require manual review, which would be your posted contractual adjustment if it doesn't match the actual payer contractual adjustments, any takebacks, denials, zero payments, held claims. And after resolving all filtered exceptions, you execute automatic account posting. As we move on, please keep in mind the following points. EFT is the transfer of funds from payer to payee through the banking system. EFT is the fastest way to move money, as the transfer of funds takes place between the banks and the same day, and the cash is directly deposited into the healthcare provider's bank account. ERA is used to electronically transmit third-party payment details to healthcare providers. In the cash posting process, each transaction must be balanced and controlled to ensure that incorrect payments are identified and the patient account reflects the correct balance. Cash handling requires proper controls to eliminate or reduce any fraudulent activities. All locations where cash or checks are received are control points which require proper vigilance for the control of fraudulent activities. Certain steps should be followed in order to implement an active daily control process. The use of EFT greatly simplifies cash balancing and control requirements, since the cash is deposited directly into the healthcare provider's bank account. It's considered the fastest way to move money. In this section, we will address credit balances, why it's important to identify them, and how to resolve them. Accounts receivable have credit balances when the payment and contractual adjustment posted to the account exceed or are greater than the total charges on the account. It's important to identify and resolve credit balances in the accounts for a couple of different reasons. If a credit balances are not identified separately from debit balances in the AR, and the balances are netted in a healthcare organization account, receivable level is going to be understated. Credit balances are also a liability of the organization and should be reported on the financial statements as such, because if you have a credit balance, somebody's going to come and take it back. If you're netting it down and taking it into your AR and not separately reporting it, you're not going to be prepared to pay that back. In addition, there are compliance requirements surrounding this. CMS actually requires that hospitals report all Medicare credit balance overpayment accounts on a quarterly basis using Form CMS 838, which must be signed and attested to by an officer of the hospital, specifically either your CFO or your CEO. Finally, states also have reporting requirements that are related to credit balances. So different states may have different requirements. I would check with those to be sure what those are in your particular state. So, credit balances can be created in a number of different ways. Surprisingly, a large number of credit balances are not the result of overpayments, but typically posting errors that need to be corrected in your patient accounting system. Common factors include billing and payment errors and hospital and payer system limitations. Allowance issues usually occur when there is a payer with multiple health plans and a patient was registered with the incorrect plan type. Late charge credits commonly originate from service departments that don't process their charges within the organization's suspense days, or min days as some call it. Corrected claims will have to be sent. Duplicate payments can happen when a provider rebills claims based on non-payment from the initial claim submission. Providers should not be rebilling when claims are not paid, and most payers do have edits to avoid paying duplicate claims. I'm sure we've all seen duplicate claim denials. If accuracy is not focused on when creating estimates, the credit balances can occur, and usually, some unhappy patients that are paying you more than what their liability could have been. And until real-time adjudication occurs, this will happen when benefits are checked and then a claim hits against it before yours. So if you gave an estimate to a patient and they have, $5,000 deductible that hasn't been met, and between the time that you submit your claim, another entity submits their claim, and now the patient's deductible has been met. So your estimate may be incorrect. So just to keep that in mind. And this also happens, credit balances also happen when your coordination of benefits is not coordinated correctly, or if the secondary is not aware that there's other coverage, which is typically rare but can happen. And then you'll have both insurance companies paying the claim as primary. For small credit balances under a certain amount that doesn't include the patient and federal payers, so those have to be refunded no matter what, the hospital should send at least one or two statements with the following information: a notification that a credit balance exists, an explanation of how to request a refund, policy of absorbing small credits if no request is received within a certain time period. The policy should be matched by a similar policy for small debit balances as well. Tracking reports should be developed to identify internally generated charge credits versus externally generated charge credits. And these reports should be reviewed with all impacted departments and used as a basis to resolve credit balance issues. So, quick knowledge check. Which statement is not true about credit balances? There are no CMS hospital compliance requirements regarding credit balances. Small credit balance should be matched by a similar policy for small debit balances. Hospital generated statements should be sent to patients regarding small credit balances, or tracking reports should be developed to identify internal charge credits versus external charge credits. You guessed it, the answer is number one. There are CMS hospital requirements regarding credit balances where you need to report all Medicare credit balance overpayments quarterly using Form CMS 838 that needs to be signed either by your CFO or your CEO. So, key points. Credit balances occur in AR when payments and contractual adjustment posted to an account exceed the overall total charges. So if your total charges are $100,000 and between your contractual adjustment posted and the payment, those two together is over $100,000, you'll have a credit balance. And credit balances should be identified and resolved to prevent the healthcare organization's AR from being understated. We're going to move on to exception-based processing denied claims. We're going to identify the types of health plan claim rejections and typical reasons for denial, recognize the practices used to reduce or eliminate rejection and denials, distinguish the two different types of appeals, and identify 5 levels of Medicare fee-for-service appeal process. The first thing a health plan does when processing a claim is to check if the patient is covered. They're going to look at the claim data to ensure the date of service is within the coverage dates and all data on the claim matches what is on file, like the patient's name and date of birth. For example, Medicare will reject a claim if the patient's name and member ID number do not exactly match the common working file. This can happen more often than desired because patient's legal name was Harold, but he's registered under a nickname such as Bubba. After the initial claim, the claim is accepted by the payer, but then additional information is reviewed. Things like, is the service covered by this policy? Was the service medically necessary? Did the hospital or provider office obtain authorization? If not, the claim may be denied. Denials can occur at a couple of different times. You can have pre-service denials. You can have at the time of service denials and post-service denials. Technical denials is based on missing or incomplete claim information, like some demographic errors, incorrect or incomplete insurance information, missing authorization or referral, missing authorization for a continuity of stay, and exceeded certain frequency limits. An example is when you have a once-a-year diagnostic procedure performed more than once within a 12-month period. So maybe screening colonoscopies, screening mammograms, bone density scans. If we're supposed to perform them once a year, once every 5 years, and you exceed that, you may see a denial for it. Clinical denials are associated with the care or service provided and may include the following. Your diagnosis does not correspond to the procedure performed. The procedure performed may not be medically necessary for the patient. May have carve-out days where clinical documentation to support care is missing. We shouldn't have that in our world today with our EMR systems, but it could happen. It could maybe not be sent to the payer. Inappropriate level of care, or your HCPCS code is incorrect for the procedure performed or authorized. An underpayment or payment variance can occur when the health plan does not pay the agreed upon contract amount. The challenge is that this type of denial is not always recognized during the payment posting. This can be incorrect payment rules on the payer or downgrading of services without a corresponding denial reason attached to the line item. Patient accounting usually has the responsibility to identify and communicate claim denial trends to move to a strategy of denial prevention. They must understand, track, and trend the reasons for denials. To be successful, PFS or patient accounting must have a method for identifying and monitoring the denials and an effective process for reversing and eliminating those denials. PFS or patient accounting should also understand, track, and trend the reasons for these denials. They can be your duplicate claims, missing authorizations, wrong insurance plan code, non-covered, MSP issues, medical necessity issues, overlapping claims, untimely filing, all those things. Some of the previously mentioned denial reasons also related to inpatient services. In addition, inpatient denials can occur as a result of the following. It can be billed as observation but should have been inpatient. Documentation does not support medical necessity. Admission notification was not done timely. Care is not supported by medical documentation. And focused reviews on the use of OBS and anesthesia in other areas. We'll move on to the different types of denials across the revenue cycle. You can have pre-service denials, and this type of denial is associated with physicians, patient access, financial counselors, and case management, also known as utilization review. Reasons for these types of denials can include not ensuring that pre-authorization is obtained for the required services, clinical information not called in for certification, insurance benefits not verified, incorrect data entry, for example, date of birth mismatch, which doesn't match the payer system, different maiden name versus married name, etc. Invalid registration information, like I may have just mentioned. Then you have your time of service denials. This type of denial associated with physicians, patient access, case management, clinical service departments, HIM, and it includes, new technologies that may have been used without determining coverage. So some payers may have experimental and investigational exclusions that have to be reviewed, especially for new technologies. Charges bundled or unbundled incorrectly according to health plan rules. Patient acuity level changes, but the type of service has not changed. Admission notification was not completed. Patient admitted as an inpatient, but maybe should have been observation. Or maybe we performed a test incorrectly that wasn't ordered. Or performed because there was a verbal order, but not an actual signed order. Patient should have been discharged, but was not. Patient treated for a medical condition while in a specialty unit. Authorization for additional days was not obtained. Or invalid coding, invalid diagnosis coding, procedure coding, DRG coding, what have you. You can also have your post-service denials. And this type of denial is associated with the clinical services department, patient access, HIM, and also PFS. Could be your late charges that are entered after your suspense days or min days. Multiple claims sent with the date of service that overlap, and untimely filing. Moving on to recovery audit contractors. The mission of RACs is to protect Medicare from fraud and abuse billings. When the RAC identify improper payments, they notify the MAC of the applicable claims. The MAC then adjusts the claim to reflect the proper payment amount. If it's an overpayment, then a demand letter is sent to the provider to recover the payments. So let's talk about managing denials. Denials have a significant impact on the revenue cycle. The most obvious impact is lost reimbursement and increased cost to collect, but productivity and morale of staff is impacted due to the rework, research, appeals process. You know how it is, being on hold for hours, trying to understand the denial, appeal the denial. So reports should include information like your denial type, organization of denials or the source, and denial frequency. They should be used to make process changes to eliminate future denials. They should also be used to track and document appeals and your overturn rates. So let's talk a little bit more about denial prevention. On the pre-service end, we need to make sure we're gathering complete and accurate demographic and insurance data, complete insurance verification for all insurances listed on the account, understand health plan requirements, complete medical necessity screening, obtain all required authorizations, and communicate that to the involved staff. Time of service. At the time that we're providing the service, we should only be providing the services ordered. Closely monitor those services and verify that all the services were ordered and provided and are clearly documented. Code accurately based on the clinical documentation and communicate to the involved staff. Then post-service, right? Complete your pre-bill edit process. Is there anything on that claim that edits against that particular payer's requirements? Categorize and analyze your denied payments to prevent future denials. Do your root cause analysis, denial prevention. Be proactive versus reactive. Monitor denial activity and the final appeals outcome. And like in every other category, communicate to all the involved staff in the process. So appealing denials. There's two types of appeal rights that people have, right? Any individual that's dissatisfied with the government or health plan claim determination is entitled to the reconsideration of the decision, with Medicare having clear guidelines and structures around those. Medicare also has specific rules on provider appeals as well. A waiver of liability refers to a provision established by Medicare to protect beneficiaries and physicians from liability when the services are denied as inappropriate or not medically necessary. If the Medicare beneficiary had knowledge or should have had knowledge that they were not covered, they can be billed. If neither the patient nor the provider knew or reasonably could have been expected to know, Medicare is liable to pay the claim. If the provider should have known or did not inform the beneficiary may not be billed. Medicare beneficiaries and providers have extensive rights to appeal individual coverage determinations. So, you've got your Medicare appeals process. You have your redetermination. You can ask for reconsideration. You can go to ALJ, Appeals Council, and finally judicial review. So if you feel strongly that your claim should be paid, 1 or 2 denials don't have to stop you. For non-government claim denials, providers must follow the appeals conditions specified in the individual health plan contracts. Sometimes these appeal requirements are provided in the contract, but if it isn't clear, the appeal requirements can be obtained from the health plan that issued the denial. Typically, appeals must be submitted within a time frame outlined in the contract. An appeal to the health plan's chief medical officer may be pursued as an appeal of final and last resort. In certain circumstances, PFS staff can obtain the assistance of the beneficiary if proper authorization is obtained from the patient to facilitate an appeal process, and if the patient financial staff are experiencing difficulty obtaining a response from the health plan, sometimes beneficiary involvement can help with that. Let's check your knowledge. Which option is not a type of denial? Technical, contractual adjustment, clinical, or underpayment? You're right again. It is number 2. Contractual adjustments are not denials. A contractual adjustment is the difference between billed charges and a negotiated contracted rate with the payer. So providers must implement denial appeals when health plans have incorrectly denied or incorrectly paid your claims. So remember these key points, right? And beneficiary appeals and provider appeals are the 2 different types of appeals. In this section, we'll talk about follow-up procedures for unpaid claims and common account resolutions. So we're going to identify steps involved in health plan and liability payers or your third-party payers and follow-up. The clean claim payment cycle should be determined for all major health plans. For example, Medicare pays clean claims within 14 days. If not received within that time frame, we should start the follow-up process. Additional follow-up should be queued based on the initial follow-up response. When a primary payment is received, the actual reimbursement is compared to your expected reimbursement. Any remaining contractual adjustments are posted. Typically, you'll have your contractual adjustments posted before you get your claim in the door, and it should in a perfect world, reconcile to a zero balance if the claim is paid correctly, or the balance will be the patient liability. If you have to post any additional contractual adjustment after the payment is received, I would check how your contractualization system is set up for this payer. Then, if applicable, any secondary claims are submitted unless there's an automated crossover provision from the primary payer to the secondary payer, which we call crossover claims. Many large health plans accept electronic claims directly from the provider or through a clearinghouse. Additionally, they may offer daily claim acceptance and validation real-time feedback so that immediate same-day action can be taken by staff if a submitted claim is not accepted by the health plan. Additionally, the health plan may provide an online portal where the provider can track the status of individual claims within its claims processing system. If a clearinghouse is used to submit electronic claims to third-party payers, daily claim transmission files are confirmed and payer acceptance of individual claims is often available daily through a clearinghouse electronic work list or report. The reason the claim is not accepted is also communicated, and you can take immediate same-day action to resolve the issue that is preventing your claim from getting to your payer. Priorities should be set for follow-up. Typically, 15 to 20% of accounts make up 80% of your AR dollars. So staff should focus on the high dollar balances to quickly reduce your AR. And to ensure that the work is being completed, real-time work in progress, or WIP, reports should be tracked with standards set for staff follow-up productivity and quality. And then for payment turnaround techniques, we want to use electronic claim submission. We can send hard copies of claims through overnight mail or same day, and send high dollar hard copy claims through registered mail with your required attachments until the electronic attachment standard is implemented. So typically your payers will ask for medical records for your higher dollar claims. Go ahead and send them proactively if you know that this particular payer always requires it. And then closely monitor your payment timeliness and backlogs of major health plans. The following are additional key focus areas, which, if not properly managed, can result in delayed AR resolution. So unbilled backlog for unverified insurance coverage, maybe coding processing backlogs, missing or late charges, unresolved pre-bill edits, and final bill not submitted to payer, which can be holding in your claim scrubber, and then billed but unpaid claims. So those are going to be your key focus areas. So your claims have to include occurrence and value codes, which help identify if the claim is accident related. Remember, premises accidents do not apply for people within their own home. So if I fall at home and I break my ankle, that's not really going to be an accident claim because it happened in my own home. Medicare allows providers to submit liability claims after a 120-day waiting period, but the provider must cancel the claim against the liability payer, as Medicare will then pursue payment. Liens are a claim against real or personal property that secures payment of a debt or performance of some other kind and gives a creditor the right to have their claims satisfied from the specific property, like a house, before the owners get any payment. So, key points. The third-party payer follow-up and account resolution activities include generating a real-time electronic work list after untimely payments, comparison of actual and expected reimbursements, adjustment posts, submitting of secondary claims if needed. And then based on your organization's policy, an unpaid clean claim, third-party claim may become the patient's responsibility after a specific number of days from your initial bill date unless it's prohibited by your contracts, managed care contracts, or state and federal regulations. Workflow for your payment cycle: a clean claim payment cycle should be determined for all major health plans. And if timely payments are not received, real-time electronic work list should be queued up to initiate immediate follow-up. So let's ask a question. Which option is not a lien type? Subrogation, number 3. This is not a lien type, but it's a process used to pursue payment. So in this section, we'll talk about self-pay follow-up, patient balance billing after insurance, the differences between bad debt and charity, Medicare bad debt rules, and their financial impact. So the managed care contract and state federal regulations prohibit the provider of pursuing open insurance liabilities from a patient. So you may bill the patient for their deductible, co-min, and co-insurance after the claim has been paid by or processed by the primary payer. Identifying and evaluating bad debt and charity accounts are critical functions in the overall AR management. Before writing a balance off to charity or bad debt, the hospital must establish a policy, define appropriate criteria, implement procedures for identifying, processing accounts, and monitoring their compliance. Financial accounting and IRS 501R regulations specify what are the pieces that need to be included in this policy. You will then also need a board-approved financial assistance policy, which is a fundamental requirement for making sure that we're correctly identifying charity and bad debt. So what's the difference between bad debt and your financial assistance, which we call charity care? The definition for recognizing the difference between these is often cited as the inability to pay, which is your financial assistance, versus your unwillingness to pay. So bad debt will be your unwillingness to pay the entire account or a portion of the balance that's not paid by insurance. Financial assistance will be your inability to pay. So you don't have the financial resources to pay your claim, but you want to. So you may qualify for financial assistance. There are many factors of self-pay follow-up and account resolution. Many providers use the federal poverty guidelines as a mechanism for assigning the accounts. Some providers design guidelines that fit the needs of their community and the mission of their hospital. Before writing off an account, providers should ensure all third-party payments owed were received and documented appropriate collection efforts that were taken. Insurance receivables should not be classified as bad debt or charity. So if you have an open AR balance from the insurance company, that is not considered bad debt or charity. Only patient balances fall under that category. A patient is eligible when they provide all documentation, which may include tax returns, pay stubs, bank statements, and meet the income criteria. Providers may include presumptive financial assistance options in their financial assistance policy to reclassify bad debt to charity when data and scoring determines they would be eligible if they would have applied. If a patient incurs excessive charges, then they may qualify for catastrophic coverage. This reviews the patient's income, disposable income, and how much of the account balance they can pay. Medicare requires that patients be pursued for a minimum of 120 days, after which they may be referred to a bad debt agency. Current Medicare regulations provide bad debt reimbursements to hospitals to compensate for uncollected Medicare beneficiary self-pay balances. Most hospitals now offer rather extensive discounts based on income and offer prompt pay discounts for those that qualify. The ACA requires the IRS to issue rules to implement the financial assistance policy sections of the ACA, which are known as the 501R rules. And this rule is only applicable to non-profit providers. So, little quiz question here for us. What is not a component of the financial assistance policy? Mission statement, payment methods, registration record, or installment arrangement guidelines? Correct. Number 3, registration record. Good job. Another question. Which option does not have to be considered in self-pay follow-up guidelines? Financial profile, presumptive financial assistance determination, poverty guidelines, or patient open balance billing? Number 4. This option is not a factor for self-pay follow-up and account resolution, but when the open balance shifts to the patient, then processing is continued according to the patient liability and follow-up guidelines. So each healthcare organization has a compliance program. Within the revenue cycle, staff need to understand the importance of compliance with federal and state program requirements. Medicare program issues related to the 3-day window, 1-day window, Medicare secondary payer, and advanced beneficiary notices, known as the ABN, as well as CCI, correct coding initiative rules. These are keys to compliant claims processing. HIPAA requirement for privacy and security, as well as the opportunities presented through the electronic transaction sets, which also impact your revenue cycle operations. Hospital organizations must meet the requirements imposed by sections 501R on a facility-by-facility basis in order to be treated as an organization described in sections 501C3. These additional requirements are community health needs assessment, financial assistance policy and emergency medical care policy, limitation on charges, billing and collections. One objective of the Affordable Care Act, or ACA, is to promote the transparency of a hospital's community health needs assessment, financial assistance policy, and to provide protections to the financial assistance policy eligible patients with respect to charges and collections. The Affordable Care Act legislation lays out requirements for community health needs, policies related to financial assistance, emergency medical care, billing and collection activities, and these regulations must be met by all hospitals that are legally designated as nonprofit under the IRS Code 501c3 regulations. One thing to note is that these regulations only apply to this designated group of hospitals. The Internal Revenue Service, by virtue of its role in recognizing tax-exempt organizations, is responsible for these regulations, which are known as Section 501R regulations for tax-exempt hospitals. Compliance with Section 501R requirements is needed in exchange for the federal tax exemption. These requirements are a cost of doing business. Compliance allows hospitals to demonstrate how much community benefit services are provided in their communities. The required community health needs assessment is typically handled within a planning or community development area of the hospital or healthcare system. The purpose of the needs assessment is to identify significant healthcare needs, prioritize those needs and identify resources that are available to address them. Because these regulations focus on identifying potentially eligible patients and providing financial assistance to those individuals, providers must pursue financial conversations with patients at the earliest possible opportunity. Extraordinary collections actions, ECAs, may not be pursued until after the hospital has taken reasonable efforts to determine the patient's eligibility for financial assistance. This section applies to hospitals as well as other entities such as collection agencies that are working on behalf of the hospital. Some examples of what constitutes reasonable efforts, which must be undertaken prior to initiating an ECA, include widely publicizing the availability of financial assistance and copies of the financial assistance policy within the community, waiting at least 120 days from the date of the first post-discharge billing statement before initiating any ECA, and providing written notification about the financial assistance policy, including a copy of the plain language summary of the policy, a notice concerning any ECAs the hospital or designated party intend to initiate, and allow any potential FAP, financial assistance policy, eligible individuals to submit applications for at least 240 days from the date of the first post-discharge billing statement, and notify any individuals who submit an incomplete financial assistance policy application during the application period about how to complete their application and provide contact information to obtain assistance doing so. Hospitals must also process an eligibility determination for all completed applications submitted within the 120-day application period. Anyone submitting a financial assistance policy application within the 240-day application period receives specific protections from additional collection activities until that application has been processed by the provider. So let's review our knowledge. Which option is not a required component of the financial assistance policy? Eligibility criteria, application process, application assistance, or out-of-network providers? The answer is number 4, out-of-network providers. The financial assistance policy must contain a list of all providers, regardless of network status, specifying who is covered by the financial assistance policy and who is not. So your key points. The ACA lays out requirements for community health needs assessment, policies related to financial assistance, emergency medical care, and billing and collection activities. The ACA must be met by all hospitals that are legally designated as nonprofit under the IRS Code 501c3 regulations. Final regulations under 501R apply to tax years beginning December 29th, 2015, and compliance with 501R is required in exchange for federal exemption, tax exemption. Next, we'll cover patient debt regulations. Identifying the 4 major titles of the Consumer Protection Credit Act that deal with granting of credit. Recall the 3 types of bankruptcy governed by the 1979 Bankruptcy Act, and recognize the components of the Telephone Consumer Protection Act. So granting credit, we'll start here. Granting credit involves adhering to strict requirements regarding how the credit is executed, what is communicated, and how the payments and principals are reported. Several regulations apply not only to the banking and finance world, but also to healthcare. The Consumer Credit Protection Act has several components. The major components of them are Title I, which is your Truth in Lending Act, which establishes disclosure rules for consumer credit sales. Regulation Z tells creditors how to comply with the law. Title III, restrictions on garnishment. A garnishment is a legal proceeding where money or property due or belonging to a debtor, you know what I'm saying, but in the possession of another is applied to the payment of the debt until the debt of the plaintiff. Title III of the Consumer Credit Protection Act establishes maximum limits for wage garnishments, which can either be 25% of a worker's disposable earnings per week, or the amount by which a worker's weekly wage exceeds 30 times the federal minimum wage, whichever is less. Title V of the Credit Card Reporting Act. And this act protects consumer rights and has exact standards that limit the use of consumer credit reports. Title VIII, the Fair Debt Collection Practice Act, or FDCPA, Act of 1978, applies only to third-party collection agencies that collect consumer debt. As long as a hospital collects its own debt using its own name, it is not considered a debt collector under the Act. The CFPB issues reviews related to activity under the Fair Debt Collection Practices Act. It's also been instrumental in persuading lenders to reduce the impact of medical debt on patients' FICO scores. So let's talk about bankruptcy now. The term bankruptcy is defined as a legal process by which a person, business, or corporation is declared to be insolvent and unable to pay creditors. Straight bankruptcy is a court proceeding that liquidates the debtor's non-exempt property, pays creditors, and discharges the debtor from his or her debt that's not exempt from discharge. Chapter 11 permits a consumer to work out a court-supervised plan with his or her creditors. It's also called reorganization. The person owing the debt has an option for rehabilitation, which is a court proceeding that doesn't liquidate your property or discharge your debts. Rather, the consumer rehabilitation serves to reorganize the debt holdings and instructs the creditors to look to the future earnings for payment, like garnishment, which is a form of rehabilitation. So let's review our knowledge. Which option is not a type of bankruptcy? Number 3, creditor priority. This is not a type of bankruptcy because creditor priority identifies a secured creditor who holds some monetary assurance of payment of debt, such as a mortgage, collateral, or lien, as a secured creditor. Secured creditors always have the first right to payment, whereas an unsecured creditor is at risk of not receiving payment. To the extent that a secured creditor's security collateral does not cover his or her claims, the secured creditor becomes an unsecured creditor. So key points. Various federal acts were passed to ensure customers and consumers are treated fairly in credit and debt collection transactions. Patient accounting staff should be aware of the various acts discussed in this course, and management must ensure that staff and outside vendors alike follow the requirements of the various acts routinely. Failure to do so could result in large fines and adverse publicity, as well as a bunch of dissatisfied patients. Moving on to medical account resolution. So here we're going to identify HFMA best practices in medical accounts resolution, distinguish key elements to consider when evaluating a collection agency, determine the advantages of using a third-party collection agency, identify the purpose of a law firm in medical account resolution. So HFMA's best practice is really to make sure everything is patient friendly, which is something that's understandable by the common person. So we want to make our bills patient friendly, establish procedures and ensure they're followed, be consistent, coordinate account resolution activities within your business affiliates, exercise sound business judgment when choosing account resolution methods, start the account resolution clock when the first statement is sent, report back to credit bureaus when account is resolved, and then track all of the consumer complaints. So there's some advantages to using a third-party collection agencies. Some of these benefits include collection agencies having tools and technologies that are effective in pursuing aged self-pay accounts. Collection agencies may collect appropriately assigned accounts faster than the provider. Collection agencies can establish a complete documentation record that may be critical in litigation activities. Collection agencies can provide additional benefits to the patient accounting staff through feedback on evaluations of assigned accounts and staff training. The assignment of accounts to an agency can provide an incentive to patients to pay the accounts timely and avoid collection agency transfers. The selection of a collection agency, is similar to an affiliation with any business partner or the hiring of a vendor for specific services. Specific HIPAA Business Associates Agreement, or BAAs as they're often called, should be included within the contract between the collection agency and the provider. One staff member, ideally a supervisor or manager in the patient accounting department, should be the sole contact for each agency used. In doing so, a provider will enable open lines of communication between the provider and the agency. So let's review our knowledge. Which evaluation criteria demonstrates reputation expectations? Correct. Number 3, the employment of staff who have documented experience working in financial areas of healthcare. So, key points from this. Collection agencies have tools and technologies that are effective in pursuing aged self-pay accounts. Collection agencies may collect appropriately assigned accounts faster than the provider. Collection agencies can establish a complete documentation record that may be critical in future litigation activities. Collection agencies can provide additional benefits to the patient account staff through feedback on evaluation of assigned accounts and staff training and other account resolution activities. The assignment of accounts to an agency will provide an incentive to patients to pay the accounts timelier and avoid transfer to the agency. And the selection of collection agency is similar to an affiliation with a business partner or hiring of a vendor for specific services. Next, we'll talk a little bit about outsourcing. So we want to recognize the role of outsourcing within a healthcare organization, determine the advantages and disadvantages of outsourcing, and identify the clauses that should be included within an outsourced contract. Outsourcing Within these areas of accounts receivable involves using outside resources to manage all or specific sections of the AR functions. There are vendors who, for a fixed rate, assume responsibility for aspects of AR up to and including appointment scheduling, registration, charge posting, billing, second billing follow-up, assignment to collection agencies for additional follow-up. So some advantages are of outsourcing are qualified staff, access to technology. The vendor absorbs some of the financial risk. Vendors' economies of scale help keep costs down. Disadvantages are impact on direct control of AR, right? You don't have your direct control over it because now you've got an outsourced agency working it. Impact on customer service, same situation. You've got, a vendor acting on your behalf, so you don't really control that customer service. Increased cost if your vendor is ineffective, and legal considerations if the staff do not identify themselves as vendors. So some considerations if you're looking to outsource is to initiate an RFP process, require vendors to demonstrate expertise and ability to handle the outsourced processes. Providers should be able to conduct on-site visits and obtain detailed references. Talk with the vendor's employees to assess their level of experience and competency. Outsourcing contract clauses, and vet the potential vendor thoroughly and get references. So let's review our knowledge. Which function within the revenue cycle is not a good candidate for outsourcing? Number one, healthcare patient services is not a direct function of the revenue cycle. And while the organization may hire contract or agency clinical personnel, the entire function is typically not a good candidate for outsourcing. Great job. And thank you all for listening to our slides. Thank you for joining us throughout the CRCR Bootcamp session online, and good luck on your test. You got this.